Hello, friends. Welcome to another episode of the Wealthlab podcast with Scott and Phil. In today's episode, you are going to listen about why insurance matters, how you can implement a strategy that will help protect your family whilst minimizing costs. And if you listen to the end, you're going to hear Phil's top tips on managing that insurance and areas that you can be thinking about and maybe you don't need to worry about.
Yeah, thanks. How are you?
Let's rock and roll. I'm well.
Let's do it. That's good. Favorite topic, eh?
So, if you search my LinkedIn profile, there was a period in time when I was the head of insurance at a corporate financial planning business, and we did a lot of life insurance. We felt like it was certainly something that I felt like it was certainly something that was very valuable, and the core principle of life insurance, in my view, and Phil, I think you might have a different view on it, is it's really there just to protect yourself. Say, for example, if you've got a young family, if you've got a lot of debt, then that's the peace of mind that product can provide. Where I'm a little bit jaded is that when I get people who are in their 50s, they have adult kids, maybe the mortgages isn't there anymore, and they're still paying this insurance policy that they've had for 12 years and they haven't really thought about it. That's an area which I'm like, let's get rid of that. You definitely don't, that's not something you need. Alternatively, people who are maybe in their 30s or 40s, they've got the kids at home, they've got school fees coming in. That income protection, that life insurance, that's actually when that should be at its largest and its most important. To not only provide that peace of mind, but just that actual structural protection on the asset position, which is you're working with us to help you achieve your future financial goals. And one of those is to hedge a significant financial risk, which is if you can't work, pass away, become disabled. So that's the summary of the insurances. That's sort of, in my view, why they exist, where they come from. But Phil, what's your thoughts on it?
Yeah, mate. I wouldn't say we think too differently there. To be honest, I think it's like anything in financial planning. I'm pretty sure I'd pull this out on every single podcast, but it's horses for courses. No two clients are the same, and we've got to do what's right for the individual in front of us. But I would say that we do really often see people in their late 50s that may have taken out a policy when they were 30 or 40. It's still a really high level of cover. They've never reviewed it, and they're paying for a hell of a lot more cover than they need. So, I would probably agree with you on that one. What I would say is, I don't love insurance, but it's a necessary evil. And I've been through, I've lost count of the amount of TPD claims that I've worked with people on. Nature of one of the previous roles that I was in, we did a lot of that sort of work. So I've seen that the benefit and the value it can add when you need it. But it's absolutely not set and forget. You don't do it once and forget about it, or you're just going to be paying premiums you don't need to as life moves on. So we'll get into some of those intricacies later, but yeah, it's an interesting one.
So what I'll touch upon here is, I think the most common one that people come to us they do not understand, which will be income protection or salary continuance or something similar. And life insurance and TPD insurance, almost everyone has some of this inside your industry fund already. And you may have been referred to us to discuss it, or you may have done some online research, you're just not quite sure. So income protection is designed to provide a cash buffer should you be unable to work for an extended period of time, usually after 30, 60, or 90 days. Say, for example, most of us have got some sick leave. I was talking to a bloke yesterday that had just started a new job. He goes, mate, I've got 5 days of sick leave and I've got an $800,000 mortgage. And my response was, well, what's your plans if you need to pay the mortgage and you can't work due to sickness or illness? And he went, oh. And that's where the sort of the effectiveness of that income protection cover can really come in and provide that peace of mind and that ongoing monthly income. So, for example, in that specific case, what we did was we put a 30-day waiting period, which is a relatively short one. More often you'll see it at a 60-day waiting period or a 90-day waiting period. And that's from the event that the injury or the accident was either diagnosed or occurred. So say, for example, you had a stroke, you've done your back, you've done your knee. I had a client with really severe pneumonia. Those are all examples of income protection claims. And then we, in those cases, we work with insurance companies to have that fund, that amount on a monthly basis put into the client's account. And so that's just an example of a client that I worked on yesterday where that was really a good fit for him.
Yeah, beautiful. Yeah, look, it's an interesting one. I think just touching on that default cover too is another thing to consider. Most people have some level of life and TPD. Not all policies are created equal, and the devil's often in the detail. So you need to have a good read of your PDS. If someone comes to me and says, I've just taken on $1 million worth of debt, and I say, cool, have you got insurance? And they say, yes, through my super. If I ask any of those people, have you read the PDS and do you know what's covered? 100% of the time the answer is no. Make sure you understand what you've got. I just came across someone the other day who is got a TPD claim going on. Didn't realize that their policy was reducing. Thought they were sitting there with a couple $100,000 worth of cover. The way their policy was structured is it reduces over time. At their age, they only had about $17,000 worth of cover left. Not even close to enough.
What was the debt?
It's a couple $100,000.
So you had 10%.
Yeah, massive problem, and they thought they were covered, but they hadn't looked at the devil, the devil in the details. So it's something to be super careful of. That's the flip side to taking out $800,000 to cover paying your debt off and still having it because you haven't reviewed it either. So it works both ways.
Yeah. So why would maybe the question that if you're asking why would I talk to you guys about or why should I consider an insurance review? Well, you've probably got some insurance already. It works best to work with an advisor because we can do a full needs analysis, identify the types of cover that work well. We also have some history with the insurance companies. We know the internal people. We know how good their systems are. We know the ones that aren't so good. We've also got some relationships sometimes with the underwriters who can assist some clarification questions around, is this a claim? What's this underwriting exclusion going to look like? And that's sort of something that I quite like stepping up and assisting, or we also work with a number of referral partners as well. Bill, I'm just going to do a screen share here, so hopefully you can see my screen. So if you just go onto the Money Smart website, how life insurance works, it's got a really good description of it. And it discusses, and when we refer to life insurance, it falls under the banner of what's called personal insurance, which is life insurance TPD, which is total and permanent disablement, which is basically if you're a potato, you're not dead, but you're permanently disabled. You're never going to go back to work. That is, serious hand injuries, serious, brain aneurysms, strokes, etc., or income protection insurance as well. That also, like as I mentioned, falls under the banner. So we utilize a insurance needs analysis tool within our business. Everyone's a little bit different. The left-hand side here, we have the capital needs. So if you were to pass away, how much cover do you actually need? How much TPD cover do you need? How much income protection do you need? So this is a tool that we take clients through, or that we'll do in the background just to identify the amount that we think is going to be a good fit for people. And then we'll take them through, we'll identify a surplus or a shortfall if they need more cover or if they can reduce their cover. And then that's going to fall into our recommendations. So if you were considering your own insurances, it might be thinking of, okay, so if I did pass away, if I did suffer disablement, what would I want to have to go to my family? What assets have I got now? And what's the gap that I want to be able to provide for them, that I can then pass that risk onto an insurance company that will then pay that fund out should anything happen to me. So that's the little tool that I wanted to run through there. And you can just go into the ASIC website, how life insurance works, to find out a little bit more about the nuances of it. And then if you're seeking to work with us, we will take you through that insurance needs analysis calculator to specifically work it out. And then we can go to the different providers as a broker, identifying which one we think is going to be a best fit for you, make that recommendation, guide you through guide you through the application process, and then also be there should you need to go on a claim. That's my little intro. Phil, what's your top tips on getting us through the application process?
Yeah, beautiful. Look, well, there's a few things there. So I even probably take a step back before we hit the application process, just some of the intricacies, I guess, and stuff that we'll take you through, and some of the terms you'll see commonly used when we're talking about insurance. So, as we've spoken about already, a lot of people have some life and disability cover through super. And we can structure retail policies. So we could go and recommend potentially a better quality product, but that doesn't mean that you need to pay for it out of pocket. So it still can be funded through super. And we've got options that they're not attached to your super fund. So, if you imagine now you're in, say, an Australian super, for argument's sake, you've got your default cover and you leave that fund, that cover doesn't follow you. It's going to be cancelled. We can do policies that you can still fund through super, so it functionally works the same way. But if you change super funds, you move around, whatever happens in your life, that policy can follow you from fund to fund. So that's something that's worth considering, just that sort of portability. Income protection, likewise, can be done through super. Doesn't always make sense. There's some different tax consequences. Income protection's tax deductible to you as an individual, whereas your life and disability cover is not. But by putting it through super, you can fund it through pre-tax salary sacrifice contributions, or you may be able to. So there's some of the things that we're sort of thinking about when we're talking to someone and structuring a policy for them. Another thing that you'll hear mentioned when discussing types of insurance is definitions. So you'll often see TPD referred to as any occupation or own occupation. Something to consider. Own occupation typically would mean cannot return to your own specific occupation. Any occupation means you can't return to any occupation that you're reasonably suited to. Now, definitions will vary slightly from insurer to insurer, but own occupation is typically much easier to claim on should you be eligible to get that type of policy. But you can't do it through super. So again, there's tricks and ways that we can structure this sort of stuff. I suppose the point of me saying all this is it's a complicated area, and it's not the sort of thing I'd be trying to do without seeking some advice. Yeah, that's probably point one to consider there. Oops, so I think you've just gone on mute there, Scott.
I was just saying it's the same as working with a mortgage broker. There's a reason why I was talking with some brokers, and they were saying over the past 3 or 4 years, the market share of mortgage brokers has gone from like 45% of all loans submitted by mortgage brokers to like 60-something%. So it's just showing how it's so much easier to work with a broker to interface with the different types of loans. Makes sense on the types of insurance as well.
Yeah, 100%. In terms of some of the intricacies, I suppose, of the application process, look, I'm going to be upfront here. It's not a fun experience. Look, the applications, there's a bit to go through, right? You'll go through a medical questionnaire. You'll get asked a lot of questions. You'll get asked some personal questions. Now, we will typically allow the insurer to do that directly with you. So, I'm not sitting here with my client finding out your deep, dark secrets, but, there's a bit to it. There's some questions there. They may write out for medical reports. Depending on the levels of cover, you may have to get a medical or a blood test. That's unusual, but it can happen. Why do we still think it's a good idea if you've got to go through this stuff up front? Because if the insurer has gone through all of your medical history and they've then come back and they've offered you terms for a policy and they've said, yes, we know all your medical history now, we are happy to offer you cover, they are on the hook to pay that policy, right? They know your medical history. They can't turn around and say, oh, you know what, you had a back injury 10 years ago and we're not going to pay you because you've hurt your back now, because they knew about it and they accepted the policy on those terms. Now, they may offer some alternatives. They may come back and say, look, we'll cover you for everything except for, this pre-existing injury that you've already got. Or, maybe you're a bit too short for your width, and they may say that we're going to charge a little bit extra, those kind of things. That's where your advisor, again, will then look at that. They'll look at what you've got, and we'll make some suggestions around whether that's a good deal or a bad deal or how to structure that to make it work for you. The point is, you go through that exercise up front, and as long as you have been open and honest with the insurer, you haven't told any lies in your application, you don't have to worry come claim time. You know that you're good. As opposed to, some policies aren't underwritten up front. So, thinking some of your super default policies, those sort of things, they'll often have what's called a pre-existing condition clause. They'll go through checking your medical history, but they won't do it till you make a claim. So, you can leave you with some level of uncertainty there around what's going to happen. I'm not saying in all cases, as I said, devil's in the detail with the policies. You need to understand it. But I personally would much rather go through the underwriting up front, know where I stand come claim time, than have a policy that I haven't answered any questions for, haven't done anything to get, and I don't know where I sit when I make a claim.
I should also point out, if you are going through the underwriting question, you should expect to have exclusions. There will be exclusions on your policy if you go through this type of cover, because this is a policy that, a retail advice policy is super comprehensive. It looks at you as a snapshot, and then from that moment forwards, you're covered. But they will look to exclude pre-existing conditions because they're not looking to take people on who have specific issues. And I'll give you an example. Super common ones are neck and back injuries or a knee injury or something like that. it's very common for that specific knee, back, or neck injury to be excluded. And they're not saying the whole, your whole body is excluded. It's just that pre-existing thing here. If that gets to a point where you have a TPD event or an income protection style event, then there won't be any claim payable on that. Another very common one is on mental health. So if you've ever seen a doctor in the last 5 years for anything about anxiety or stress, which we all have, then it's likely there'll be what's called a mental health exclusion placed on the income protection policy. And like what that means is if you have a mental breakdown to a point where it's so bad that you then can't return to work for more than 30 or 60 days because you've had such an extreme breakdown, then it won't pay. That's the only area that's specifically excluding. So if there's any other sickness, injury, or event that occur in which you are unable to work, the insurance will pay out. But a mental health exclusion is just that, specifically on should you have a mental health breakdown, then there won't be any cover. So I'm just saying that one now because it's so common. Pretty much everyone has it. So I'm just flagging it now so that we can get it out there to the world.
Yeah, it is a super common one that comes up. It's not often, especially if you've got a 4 at the start of your age, it's pretty rare that you've gotten to that age without something going wrong along the way. So, but the point is, at least you know where you stand when you make a claim. You know what's going to happen. You know what you're covered for, what you're not covered for. One other thing, one other thing I wanted to call out that's definitely worthy of consideration and that nobody really is aware of until the time comes and it's too late is, not that I want to go and call our benevolent government a bunch of miserable bastards, but I will in this circumstance. TPD claims. If you make a claim on total and permanent disability on a policy that's held through superannuation, a portion of that payout is likely to be taxable. Now, I don't know whose bright idea it was to tax some poor bugger that's just been made disabled on his money that's there to help him out of the problem, but that's the way it works. So something to be aware of, because if you're looking at your superannuation policy, for argument's sake, you got a $500,000 mortgage, you got $500,000 to cover, and you think, oh, sweet, I'm all good. You're not. No, they're going to take a chunk of your tax and you're going to be left with the mortgage. So something to be aware of. It's a complex and convoluted formula that I'm not going to bother going into here, but you do need to know that there is tax payable, and it is something that if we're structuring policies through super that we consider when we're working out how much cover you need. Second point to that is, as someone that's worked on a ton of TPD claims for people, how you access that money will have a big difference or a big impact on A, the tax you pay, but B, also potentially any disability if you're eligible for disability payments from Centrelink and those type of things as well. So if you're eligible for a TPD claim, don't just run at it blind, rip the money out and away you go. You're likely to get a significantly better outcome by structuring the way you access that money a bit more sensibly. So again, that's a pretty complex area that I'm not going to get into on a podcast because I'll put everyone to sleep. Other than to say, if you're in that situation, you need to speak to an advisor. You're a madman if you don't. And that's my rant about tax on TPD. You can tell it's a bit of a bugbear. Yeah. Yeah.
All right, guys. I didn't want this to be a long one, but we've gone on for longer than we expected because we both rattle on about things we're passionate about.
Yeah.
The too long didn't read is this thing's important, but it's something you should set and forget. Once you're working with an advisor, we will then be reviewing it on an ongoing basis.
Yeah, absolutely.
We need to go through the health questions. So you need to be honest. You need to be clear. The worst thing you can do is going through the application process is saying, I hurt my back this one time 2 years ago, but I didn't see a doctor about anything. All right. Alternatively, be very, very specifically clear on what illnesses you've suffered. Just get a sense on it. You can call your mum or something like that if you're not sure about any family history beforehand, and then we can help navigate that process through. But yeah, my suggestion is when you're going through an insurance application with the underwriters and they're asking you some medical questions, you don't need to sort of elucidate. But if they're just saying, my response is usually yes, no, or I'm not sure, I'll get back to you. And that's usually the way that I suggest people consider going through their insurance application questions, because it just makes it very clear for everyone.
Yeah, beautiful.
Excellent.
Nice.
All right. Thanks, guys. Thanks so much for listening. We'll see you next week.
Cheers. Bye.